Hyperscale Data Inc. GPU's full investment analysis date. September 11, 2025. Executive Summary. Hyperscale Data GPUS is a diversified holding company focused on data centers, Bitcoin mining, and a set of operating subsidiaries across construction, energy, fintech, hospitality, and software. Its flagship asset is a large, Michigan hyperscale data center with current 28 megawatts capacity and potential expansion to 300 megawatts. The investment case is speculative. There is upside if the company secures long-term GPU AI hosting contracts and expands its software licensing. But downside risks from mining volatility, leverage, and financing needs are high. Key takeaways. Michigan data center asset provides a credible foundation for growth. Financials show revenue in the $100 to $150 range, but continued net losses. Balance sheet leverage is high versus equity. Frequent equity and shelf registration filings imply ongoing dilution risk. Recommendation: suitable only for speculative investors who can tolerate execution and liquidity risks. Company overview and business model. Hyperscale Data operates across data centers and AI compute hosting. Revenue from colocation and GPU workloads. Bitcoin mining. Volatile revenue, tied to BTC prices and halving cycles. Subsidiaries. Circle 8 Crane Services, hotels, energy businesses, fintech lending, and software licensing. The Michigan facility is the strategic asset positioned to capture AI-driven GPU demand. Industry and market position. Industry context. Global hyperscale data center demand is accelerating, driven by AI cloud computing and GPU adoption. Large players like Equinix and Digital Realty dominate, with billions invested annually. Hyperscale Data's position owns a 617,000 square feet Michigan data center with 28 megawatts live capacity and 300 megawatts potential. Competes against far larger capitalized incumbents. Needs partners and favorable power agreements to scale. Financial statement analysis, key metrics, latest filings and aggregator consensus. Revenue, $100. 150M pro forma consolidated. Net loss, approximately $27 million for the first half of 2025. Assets, low hundreds of millions. Debt, around $100 million. Cash, tens of millions. Equity, very small due to accumulated losses. Interpretation. Revenue base exists, but profitability is negative. Cash reserves are modest relative to growth ambitions. Debt to equity appears high, reflecting thin equity, valuation, and multiples market cap, under $100 million. PE and PEG, not meaningful due to negative earnings. EV revenue, modest, suggesting low valuation relative to reported sales. EV/EBITDA, not stable until consistent positive EBITDA emerges. DCF illustrative, model-based revenue, $125 million, growth, 10% year one, tapering to 5%. EBITDA margin, 8% ramping to 15%. CapEx, 8% of revenue. WACC, 14%. Terminal growth, 2%. Result valuation is highly sensitive. Optimistic assumptions support fair value near current levels, but downside dominates if contracts don't materialize. Profitability and efficiency. Gross margin, highly variable across segments. Operating margin, negative, due to SG&A and integration costs. ROE, negative. Equity base, distorted. Working capital, mixed trends. Some stability in crane services, volatility in mining, liquidity and solvency. Debt, around $109 million. Cash, tens of millions. Debt equity, extremely high due to small equity financing. Shelf registrations filed suggesting reliance on equity raises. Growth in earnings performance. Revenue growth opportunities in AI hosting and software licensing. Bitcoin halving in 2024 reduced mining revenue. Analyst coverage is thin. Forward estimates are limited. Dividend and capital allocation, no dividend history. Capital allocation focused on acquisitions, expansion, and maintaining liquidity. Shelf registrations indicate continued equity financing. Management and governance, frequent press releases and filings. Insider ownership limited. Board and governance practices require scrutiny in annual filings. News and sentiment announced NVIDIA GPU deployments at Michigan facility. Expanded cloud partnerships. Crypto mining revenue declines post-halving. Shelf registration amendments highlight future dilution risk. Competitive landscape and SWOT. Competitors. Equinix, Digital Realty, QTs, Marathon. Riot. Strengths, Michigan, asset. Diversified subsidiaries, early GPU deployments. Weaknesses, small scale, high leverage, negative profits. Opportunities, AI hosting demand, software licensing, expansion to 300 megawatts. Threats, capital intensity, dilution, crypto volatility, incumbent competition. Technical analysis. GPUs trades thinly with high volatility, subject to sharp swings on press releases. Liquidity risk is high. Use limit orders. Catalysts and risks. Catalysts, multi-year hosting contracts. Software growth, power agreements enabling expansion. Risks, mining, revenue volatility, financing dilution, execution risks in multiple segments, regulatory and energy constraints. Comparative analysis. Digital Realty, Equinix, much larger, stable, recurring revenue, higher multiples. Marathon Riot, pure play miners with scale advantages. Hyperscale's strength is its physical Michigan site. Its weakness is lack of scale and consistent profitability. Investment thesis bull case. Signs GPU hosting deals, scales Michigan site, software grows, large upside. Base case. Partial execution, some dilution, moderate returns. Bear case. No contracts, mining weak, dilution heavy, equity declines sharply. Conclusion: Hyperscale data is an ambitious but risky play. The Michigan data center is a real asset, but execution, financing, and scale are all uncertain. Until recurring contracted revenues and profitability emerge, the stock remains a speculative bet best suited to risk-tolerant investors.